Hello friends, today we are going to start a new chapter. This chapter is about capital structure and leverage. This chapter is continuation of, let's write here, capital structure and leverage. Capital structure and leverage. Okay. This chapter is continuation of the cost of capital. Continuation of the cost of capital, because cost of capital defines that our capital has a cost, like right hand side of the balance sheet debt. Let's write it like liability, owner's equity. It has some cost, okay? It has some cost because we attract some capital here, total capital, total liabilities plus owner's equity. These dollars, they have some cost, whatever, like 11% per year annually, annual costs, okay? Annual costs. But this capital structure, we will define like we just in a cost of capital we just define they have the cost, okay? But in a capital structure chapter we will define what's the best proportion, like what's the best proportion of debt, whether it should be 500 or 1000, or whether it should be 1000 and 500, or whether it should be like 1500 0, or vice versa. What the proportion of the debt or equity should the firm attract? There, we will define this as a pie, okay? As a pie, because if you have like 15% of the pie as a debt, the rest 85% will be owner's equity, or vice versa. If this will be owner equity, the rest will be debt, okay? So there is a dilemma. So we'll define it like a pie example, with a pie example, tort. If you get 15%, the rest will be other source of capital, okay? We will see in this chapter what's the optimal debt or equity structure, owner's equity structure. What's the optimal? How much should be the debt? How much should be the equity? What's the best way? Okay. Let's continue. That was some introduction, the general idea about the chapter, what the meaning of the chapter, what we will look for in a chapter. Let's start with our just a second. Okay, the chapter capital structure and leverage. We will go by this PowerPoint presentation and we will refer to our CFA book, like there is measure of leverage. Okay, capital structure and leverage. We in this PowerPoint we will define 4 points. We will discuss business and financial risk, what's a business risk and what's a financial risk. Then we will discuss optimal capital structure, as we said, like what the debt or equity. We will define like operating leverage. Then we will define in our CFA book financing leverage, and we'll we will discuss capital structure theory. First of all, let's suppose, let's have an example. Let's one by one discuss what does mean capital structure. Структура капитала. Capital is a money. Okay, the money. Structure is структура. Структура, like what the shape, the money, where the money should come from. And the leverage. I like this capital structure, структура капитала, структура денег. Это понятно. Debt or equity. Okay, debt or equity. But what does mean this leverage? Okay, let's define the leverage. Like technically, leverage means рычаг. The main idea here is about, like, let's do it like that. If it will be in the middle, like if we'll force here like 50 kilos, okay, and 50 kilos, they will be equal, yes, to each other. And the leverage, like if you remember the weights, весы, okay, чашные весы, okay, 50 kilos, it will be equal when it will be in the middle. When it will be in the middle. What happens if we like slide it to the right? For them should be equal. This side, the left hand side, we can apply less force, yes, less force. For example, we can apply 10 kilos. Then they could be equal. With 10 kilos, you can lift up 50 kilos by moving from middle to the right. That, like, this process called рычаг. And we can see this method of the рычаг. For example, when you are pruning, like you have a tree or whatever, and you cut this tree, okay, we call it секатор, let's suppose, like, or scissors, yes, you hold here, then you cut your trees. Or like in the pyramids, when you want to lift heavy stone, you apply here leverage, yes, you put here little stone, and this will be leverage. You put the pressure and you can roll the stone. Method рычага. Then we have how this is applied, okay, how this knowledge is applied to our financial world. Рычаг means leverage. We have financial leverage. Финансовый рычаг. Финансовый рычаг воздействия. It means you apply less force, but you want to lift more heavy, yes? You apply less heavy and you want to lift more heavy by using рычаг, leverage. So, in our example, the direct, like, usage of this is about, like, owner's equity is your own money, yes, own money. This is your own money, and you want to start a business, for example, one that costs $10,000 business. You want to attract assets for the $10,000 worth of assets, but you have only $1,000, okay? What should you do? It's your own money, but you want to open like $10,000 business. You go to debt. You get external capital. You borrow from your friends. It's like this borrowing, external capital, borrowing called leverage. Like, you have only 1,000 and you get $9,000 from external source of capital, and it will be like that. We have here the weights, you want to open $10,000 business, but you only have 1,000. You only have 1,000. What should you do? You want to open a business. You will do some leverage, yes? This like 900 will be your leverage. So you can open the business with 1,000 that worth 10,000 by going to debt. Then you move this leverage here. Then you can operate your business with using business for $10,000. Okay, if it's okay, if it's like process of leverage is okay, the meaning what's come from financial leverage and like just simple technical leverage, if it's okay, let's proceed. Let's continue. Then let's continue to our chapter. Okay. And here we have some like definition of the risk, okay? Business or financial risk. What's a business risk? Business risk, uncertainty about the future operating income. Like from the accounting perspective, business risk is connected to the EBIT operating income. How well we can predict operating income. This like probability and our EBIT. Like this is low risk because you have EBIT goes like with the probability that EBIT will be high. Here high risk that EBIT will be low. Okay. Next, what determines business risk? The generally business risk is day-to-day, like uncertainty about demand. Your risk about the demand, about the sales, future sales, uncertainty about the output prices, what going to be in the prices market, uncertainty about your costs, your suppliers can charge you higher costs, products as a type of liability, what will be your products, will the market demand will change to the products, for example Nokia. We don't have Nokia because new products emerged. And operating leverage. We will like define this operating leverage in detail. Then, what's operating leverage and how does it affect firm's business risk? Okay, just a second. Operating leverage, as its name suggests, it's about operations, day-to-day operations. And day-to-day operations are about, for example, let's come to our income statement. Okay, let's come to our income statement. We have income statement. We'll start with revenue. Then we have expenses. Then we have earning before interest and tax. Then we have interest. Then we pay, let's write it directly. Then we pay tax. Then we have net income, okay? This is our simple income statement. And here, operating leverage, as its name suggests, it's about this, like from the revenue till EBIT. Let's like have it separately. We have revenue. Then we have two types of costs. Yes, first cost is fixed cost. Fixed cost. Second, we have variable cost. Then we will subtract this from the revenue. Then we will have earning before interest and tax. And this called is operation, day-to-day operations of like this is gross revenue, gross profit, and we have operating profit. What about the costs? Like fixed cost could be rent payment, fixed cost could be wages, fixed cost could be utility bills. Okay. What about the variable costs? Variable costs could be like per unit sold. I don't know, like per unit sold. Like this could be like if you quantity will rise, variable cost will rise. It could be like incentive to sellers. For example, you say like if you sell one unit, you will have like $100. If you sell 20 units, you will have like, let's suppose like 10 units. Your income will be like $1,000. It's like incentive per unit. This will be cost for the company. Like if the unit number will rise, increase, so the payments, the cost for the company that is paying for sellers also will increase. Okay, this is per unit, like variable cost. As the unit costs, unit sales change, unit cost also change because you have to pay per unit cost. Okay, but the fixed costs are fixed. If you sell one unit, you should pay, for example, 100. If you sell like 100 units, also your cost is fixed. Like this is fixed cost, okay? It could be like rent payments for the property, rent payment. It doesn't affect how much unit you are selling. You should pay the fixed rent payment. It doesn't affect how many students are studying in university. You pay like fixed utility bill for heating, electricity, or whatever. Okay, so this is like fixed and variable costs. You should be very very careful about like what is fixed, what's variable cost. We should know for sure. Okay, so this is like, we can also erase here. So costs contain like these are total costs, and there is a dilemma. Sometimes, for example, you can one cost could be like cost, for example, which cost building cost. It could be fixed cost or variable cost. You can choose. For example, if it's fixed cost, it could be, for example, this could be rent. Or if it's variable cost, you can like, how to define it? If it could be variable cost, your rent, you can buy it, okay? You can buy the property. Buy the property. Rent or buy. Another example. Wage. Okay? Wage. It also could be wage payment, salary. Could be fixed cost or variable cost. For example, it depends on your deal with your seller. Okay, seller. Wage for seller. For example, you can pay him. You can agree paying him $1,000 per month, or you can like make him some incentive, like 15% from unit sold. Okay, 15 from the unit sold, and he has some incentive to sell a lot, because per every sale he has 15% of that share. But here the seller is working for the wage. Okay, so this wage it could be fixed or variable cost. We will define. Okay, that's it for now. Then if we are clear with fixed cost and variable cost, it's like what's operating leverage and how does it affect the firm's business risk. Operating leverage is the use of fixed costs rather than variable cost. Okay, we have fixed cost and variable costs. We are okay with that. Then if most costs are fixed and don't decline when the demand falls, then the firm has higher operating leverage. Let's look. I want to drive your attention to this graph. Okay, to this graph. We have here, this graph is about, we have more of fixed cost. Here we have more of fixed cost, but here fixed cost is less. Like this is dollar terms, and dollar paid for fixed costs we have less, but here at the right hand side we have a lot of fixed cost. Then we have here sales. To the right we have higher sales, to the left we have low sales. So the situation, for example, we get this situation. It's a break-even point. Here is a break-even point that company quantity break-even means after this point of sales, for example, whatever, like selling the cars, after the sales, your revenue is higher than your costs. Like your revenue is higher than your costs. After like this area means you are making profit. But this area means your total costs are higher than your revenue. Like you are working for your loss, okay? So the two situations, fixed cost or variable cost, because fixed cost we have fixed, but variable cost is a difference here. Difference here is a variable cost. Okay. In this situation, let's clean here. Like you should judge, like let's judge which is more profitable, having a lot of fixed cost or less fixed cost. Okay, when the sales are high, the fixed cost is better. Like for example, in this situation sales are high. You have fixed cost and you have total costs, because, for example, let's first of all draw your attention here. If the sales are zero, we have zero sales, so we have our costs are high, because whatever, if you are not doing sales, you should pay rent. Okay, here it doesn't depend on your sales. If you have zero, like даже если не работаете, вы должны платить аренду. So fixed cost rises the sales. When the sales are zero, you should pay. If you don't have like rent payments, if your sales are zero, you don't have a lot of expenses. But for example here, when you are having a lot of sales, per unit sold, you have fixed cost. Like per unit sold, variable cost will increase our total cost. Like variable cost, like here variable cost, we have a lot of variable cost. This is variable cost. We have variable costs here. If we have less fixed cost, so we should have a lot of variable cost, per unit cost. So it will increase our total cost and our revenue will be less compared to here. Net profit will be, because you are renting your house and you are not paying. Like you agreed with your wage will be fixed cost. Then your sales will rise, then you will have less variable cost. But you agreed here that wage will be variable cost. As your sales will rise, you should pay higher amount of money to your sellers, so the revenue will be less. Like this is a dilemma, okay, dilemma, how, whether it should be fixed cost or variable cost. Okay, that's it. Then using operating leverage, we can skip this. Okay, the next thing is about, like, let's look to this like to the situation from the perspective of the CFA book. Okay, then we have here some calculation. Like this DOL is about degree of operating leverage. We can take it like that, screenshot, and then we can use it. Just a second. Here. Okay, let's work upon this. Okay, we have here degree of operating leverage. We can, okay, we can discuss this, like we can find this degree of operating leverage, like sales, fixed cost and variable cost, and earning before interest and tax. We can measure, like we said, we can measure the effect of the fixed cost and variable cost. Do we make the good decision about the fixed cost and variable cost? We can measure that. The formula is percentage change in EBIT and the percentage change in sales. Okay, dividing percentage in EBIT and percent change in sales. We have the formula here, change in EBIT over change in EBIT. Then, or we can use this like expanded formula, quantity multiplied by price minus variable cost over quantity multiplied by price minus variable cost minus fixed cost. Okay, and this gives us the knowledge about if the sales will change 10%, how the earning before interest and tax will change. Will it change, for example, 15%? Or will EBIT will change, for example, 25%? Which situations is good? Like if sales will rise 10%, 25% rise is good. But there is also the risk that if sales will decline 10%, the EBIT will decline 25%. So there is a risk of this kind of risk, and we will be measuring this kind of we will be measuring. So let's have some example. Let's discuss some example. Okay, in this example, friends, we have two companies, Beta and Atom company, and they have the price of their product is the same, but variable costs are different and the fixed costs are different. One firm has a higher fixed cost and lower variable cost. It means it's relying on mostly spending mostly fixed cost. Second company has less fixed cost but higher variable cost, and their revenue are the same. They are selling the sales are 100,000 units, and for example it means their revenue is 400,000. Then they have fixed cost. For example, this is Atom company, this is Beta company, and the fixed cost R for Atom company is 40,000. Here is 120,000. Then variable costs per unit cost. We have if 100,000 unit, we will multiply 100,000 with for Atom for $3. It will be 300,000. Here we have $2 per unit sold. It will be 200,000. So we should calculate their earning before interest and tax, EBIT. It will be EBIT will be 60,000. Here this is minus 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 minus. Here EBIT will be 80,000. So which is better? Like 80,000 is better. Then we can calculate, like we have here calculation of the DOL. Okay, DOL for beta, degree of operating leverage for beta is 2.5. Degree of operating leverage for Atom is 1.67. Okay. This means that if the Atom's sale will increase, for example, 10%, for Atom company, EBIT will increase 16.7%. If the sale for beta will increase 10%, it will increase 25%. EBIT will increase 25%. Okay, this means this situation means that. But there is also downside. If the sales will decrease, the EBIT for Atom will decrease less than decrease in EBIT in a beta company. So it's a volatility, it's a riskiness, okay? It's a riskiness. Then the companies will choose their best strategy. Okay, but the this DOL means that. Okay, and in this situation, holding more fixed costs makes company more volatile. Volatile means it could be advantage or it could be disadvantage. It depends on the sale. So it makes it some depending on the sale. The next, with the debt, what about degree of operating leverage? Okay, then we have the next, we have financial leverage. We have financing leverage. It was operating leverage, and we have the next thing is financing leverage. Financing leverage is about use of debt, okay, and preferred stock. Financial risk is the additional risk concentrated on common stockholders as a result of financial leverage, okay, as a result of the financial leverage. As we said, friends, let me erase this. As we said, if you have, like before it was owner's equity 1,000, debt is 900, and overall, like you can lift the company of $10,000 company. You can start the business with a $10,000, only just having 1,000. But here you have some risk because you get some external debt. We have here in a formula in the income statement EBIT. Then you should pay interest expense. Then you should pay tax. Then you will have net income. From this net income, you will have your ROE, return on equity. Yes, it's about formula net income over common equity holders. And if you have less net income, it means like your ROE will decrease. Those like net income. Then we have degree of financial leverage. Change in EBIT, how it will change net income. Okay, and it depends on our interest rate that comes from our debt. If you have a lot of debt, you'll have a lot of interest payments every year for that debt, then this will decrease your net income. So taking debt is good because you are working with like you will be able to work with a greater amount of capital. Okay, but this a lot of debt causes you to pay a lot of interest rate for that debt, and this causes you to be net income to be lower. And if the net income will be lower, every equity holder will get less money. ROE means every equity holders get the share from net income. Like it's a profitability for common equity holders, because common equity holders stays the same. So that's a dilemma. How much debt should the company take? Okay, and we will measure that in a financial leverage. The next, business risk and financial risk. Business risk depends on the business factors such as, like as we said, business risk is about competition, product liability, operating leverage, like fixed cost, variable cost, day-to-day activities, competition of the market. What's a trending, for example, what's trending now? Is it like smartphones or Nokia? If you are Nokia operator, you should look for your product liability, like do loyalty, do your customers are loyal to the company, or as other factors like marketing. These all are business risks. Okay, financial risks only depend on the dilemma of is it debt or equity. The main is about the debt or equity. Should we get more debt or should we issue more equity? Okay, the only dilemma is this risk of this. But in a business risk there are a lot of risks, like day-to-day operational risk. Okay, and we have here, as you should be familiar with this like illustration, it's about unleveraged firm and the leveraged firms. We have here two kind of situations. Okay, two situations. There is no debt for unleveraged, 20,000 of assets, tax rate is 40. There is a debt like the half. If there is 20,000, the half, 10,000 is a debt with interest payment of 12% for that money. We have three case scenarios: bad and average and the good case scenario. It's for unleveraged firms. There is no debt. So probability is 50-50 that economy will be good or bad. Bad probability 25 good probability. Your EBIT, for example, in an average situation, your EBIT will be 3,000. In a good situation, you have higher EBIT. In a bad situation, your operating income is lower. So there is no interest because it is unleveraged. You have no debt. So your EBT before tax will be the same as your EBIT because there is no interest payment. But your tax is dependent on your EBT. Then you have some net income for your can be distributed to shareholders. Then in a case of leveraged firm, also the probability is like average cases, average bad and good cases. Probability is 50, 25 and 25. You have the same EBIT, but you have some interest payment. Like you should pay what we had, like 12% of the 10,000. You have 10,000. 12% of the 10,000 will be how much? Will be 1,200. 1,200, and this is fixed. It doesn't depend on the situation. So your EBT respectively will be lower because you will be minus this. You will be subtracting this. So the tax rates are respectively. Then you have here also net income can be distributed to common equity holders. So let's compare. We will be comparing the ROE. The main indicating factor is a ROE. In an average situation, the ROE for leveraged firm is higher. This is higher. In a good situation, ROE for the leveraged firm, this is leveraged, this is unleveraged. The taking debt is good. This is not good. Like in good situations, taking debt is good. Every shareholder, ROE, net income over common equity holders. Every shareholder gets 16.8% income, okay? Income. In a good situation, taking debt is good. But in a bad situation, taking debt is not good, because in a bad situation, you had a bad case, then you should pay interest payment, so your EBT, like net income, will be lower. As long as you don't have interest payment here, in a bad situation, you are doing better than in a leveraged firm, because you don't have debt, you face the bad EBIT, but you don't have debt payment. But you suffered, but not as suffered as you got to leverage some debt. Sorry. That's a strategy. If you foresee the good situation, it's better to be financed with mostly debt. If you foresee bad situation in the future, like for example, it will be like some recession, some bad economic condition, so you shouldn't take debt, okay? You should issue some securities, like owners equity, shares. You should issue some shares, okay? What about, like, what about how to calculate financial leverage? To the numbers, we have the formula for calculating financial leverage. Let's take this. Sorry, let's take this as an example. We can erase this. Okay, we have a formula of degree of financial leverage is about percent change in earning per share, percentage in earning per share over percentage change in EBIT. Okay, in other words, it is EBIT. Okay, interest, we have here tax payment, that we have net income. For every change in EBIT, for every 10% change in EBIT, what's the change in earning per share? It is not only net income, it is net income over common equity. Earning per share, for every earning per share, what will be this change? For example, whether the change will be 15% or whether the change will be 25%. Like if your earning before interest tax will rise 25% or 15%. And this degree of financial leverage will define this. The formula is EBIT over EBIT minus interest, or also the expanded formula is this. Let's have some example. Let's discuss some example. For the Atom company, okay, operating income for selling 10,000 was, if you remember, 60,000. Interest expense, like EBIT, interest expense was 18,000. Then you have EBT of 42,000, sorry, earning before interest and tax. Then the tax rate is, I think it was 40%, yes, 40% of the tax rate. What's the 40% of this? Let me calculate. Okay, this is 1.6 minus 42,000. We have here 25,200. Okay, this is net income, and we should divide it by number of equity holders. Okay, number of equity holders, number of common equity holders. Then we will have some number, or we can plug it in a formula, and we will have like this degree of financial leverage will be 14.3%. It means 1.43 or 14.3%. It means if the EBIT will rise 10% or rise or fall with 10%, our ROE, let's say it's ROE will rise or fall with 14.3%. In a good situation, if it's rising, in a good situation it's good because you will be rising 14.3%. But when you are falling, it hurts, okay? It hurts because it will be falling 14.3%. So it's like volatility. If it's rise or fall, respectively, ROE will rise or fall respectively. Okay, that's one example. Okay, then next let's continue with our knowledge about basic. Okay, as we said, we should choose the optimal capital structure. What's the optimal? What the best that capital structure mix of debt and preferred stock and common equity, trace of higher expected ROE and earning per share against higher risk. Okay, as we said, if your degree of financial leverage will be high, it's better in good situations, but it's bad in a bad situation. So there is a high risk. The tax related benefits, okay, mix of debt, as we said, let's skip this. Okay, here is another thing. There is like one example of Campus Delhi company. New debt is issued. Okay, then the proceeds will be used to repurchase the stock. The main thing we want to accentuate here that the new issue of the debt makes every new issue of the debt, here is amount borrowed. It's a new issue. If you borrow 250, then next 500 borrowed, then next 750 borrowed, then next 1000 borrowed. Every borrow, like it's debt to total assets, your debt will be rising. The proportion of the debt in the total assets will be rising. Debt to equity ratio, this is also rising. Okay. Then the bond rating, it's your rating of the bond will be falling. Let's accentuate your attention here. Your bond rating, higher bond rating is better, but every new attracted debt will be decreasing your bond rating, because каждым разом, когда вы будете брать в долг, вы становитесь неплатежеспособным. У вас уже есть долг. Новые, кто будет вам в долг давать, они будут рисковать. Почему? Потому что вы еще старый не выплатили, еще берете новый долг. Каждый новый долг делает ваш рейтинг ниже. Если ваш рейтинг ниже становится, каждым долгом ваш cost of capital, cost of debt, который вы выплачиваете, должен расти. Почему? Потому что вы должны компенсировать этот уже ваш слабость компании. Ваша компания становится слабой. Почему у вас становится больше долгов? И вы должны компенсировать эту слабость, повышая процентные ставки по вашим долговым обязательствам. Тогда только будет вам деньги выдавать в долг. Почему? Потому что если вы слабая компания или же становитесь не платежеспособной, вы должны повышать, ставки повышать должны. That's a main case, okay? Then, as a firm borrows more money, the firm increases its financial risk, as we said, causing the firm's bond rating to decrease and its cost of debt increase. Okay. Let's skip this. Okay. You can stock price. You can also skip this. Okay. What effect does increasing debt have on cost of equity for the firm? Okay. How it affects the cost of equity for the firm? As we said, increasing debt causes the cost of capital as a cost of debt to increase with a new debt issue. But how it affects of the cost of common equity? If the level of the debt increases, the riskiness of the firm increases. So you are holding the stock of the riskier firm because it's issuing more debt. But you're like, it means like your chances of getting higher ROE also increases because this debt, new debt, could make your degree of financial leverage higher. We have already observed the increase in the cost of debt. Okay, we are done. However, the riskiness of the firm's equity also increases. This also increases risk, resulting in the higher cost of common stock. So, as you attract more debt, your cost of debt is higher, then the cost of equity becomes higher because it becomes riskier. Riskier means there is an advantage to get more money or to lose money. Okay, let's look in this situation. If you remember, yes, in this situation, if you remember this situation, taking more debt, okay, let's here, taking more debt, taking more debt in good situations, you get higher 16.8, here 12%. But in the bad situations, you are riskier, okay? It means this is lower. You get lower return in a bad situation. But in a good situation, you get higher return. So this is riskier. Because it is debt. And every debt makes it more riskier than before. Okay, and there is a Hamada equation. Because the increased use of debt causes both the cost of debt and equity to increase, as we said, we need to estimate the new cost of equity. Okay, so we should calculate the new cost of equity. This equation attempts to qualify the increased cost of equity due to financial leverage due to new debt. Okay, financial leverage means increasing financial leverage means new debt. Uses the unleveraged beta. We should use unleveraged beta of the firm, which represents the business risk, only the sole business risk. Okay, if you don't have interest payments, you rely only on business risk, on your operation risk of a firm as if it had no debt. The formula for beta of leveraged firm is this: beta unleveraged multiplied by 1 plus 1 minus tax rate debt to equity ratio. And there is an example. Suppose risk-free rate is 6%, as is the market risk premium. The unleveraged beta of the firm is 1. This unleveraged firm is beta 1. We were previously told that total assets 2 million. Total assets is 2 million. Okay? And we have some scenarios. If the debt here is, I think it's supposed in like in thousands, okay? So it is 250,000 over, like if you plus this, it will be 2 million. Okay, 2 million, sorry, 2 million. 2 million is total assets. It equals debt plus owner's equity. As in the formula, we got equity here, okay? So debt over equity, 1 minus tax rate, beta for unleveraged firm is 1 from the formula. Beta is 1. Okay, then the beta for leveraged firm is 1.0 something, okay? Beta for leveraged firm. And it is KPM model, as you remember from the cost of capital. KPM model, capital asset pricing model. It's a risk-free rate. It's a beta of the firm. It is return in the market minus risk-free. Okay. So we have the cost of capital, cost of capital. So in a table, new amount borrowed, you just change this. 250. If you add 500, your cost of capital, cost of common equity will rise, okay? Cost of capital will rise with a new borrowing, because it makes it cost of equity to be riskier with a new purchase. Why riskier? Because company got more debt. This more debt makes common equity holders riskier, because the company should face the interest payment. So it makes the company equity holders riskier. Okay. So finding the optimal capital structure, the main answer for this chapter is finding the optimal. We said higher debt is increasing, but what's the optimal? Is it like if the company takes no debt? If the company takes no debt, okay. If the company takes no debt, in a good situations it forgoes. In good situations it doesn't get a lot of profit as companies that got debt. So what's the best situation? Not taking debt. If you don't take debt, as we said, if there is no debt, okay, because there could be like division, like no debt, no pain. Yes, no, but it doesn't work like that, because if you don't pay if you don't get debt, for example, owner's equity 1,000, you got just $1,000, and you just open only $1,000 business of assets. If you take 900 debt, you get plus extra 900, and you can open the business for 9,000. You can open business with a 10,000. This 10,000 will generate higher revenue in the future. From the higher revenue, you can pay your interest, you can pay your fixed costs, you can pay your variable costs. Then you will have higher net income. This higher net income will be distributed to the common equity holders less common equity holders, then you'll get higher ROE. You'll maximize the common equity holders' interest, okay? Everything is interdependent, but everything is dependent. Like you get, for example, in a bad situation, you get this and you will have lower EBIT. This lower EBIT means lower EBIT, then you'll pay interest expense, then you'll get less net income. In that situation, it's better to not to get debt. So debt is not like very cruel thing, so you should, but there is a dilemma. There is a dilemma. Optimal, what the best optimal structure of the debt and equity? The firm's optimal capital structure can be determined in two ways. First is minimize the WACC, weighted average cost, we said minimum WACC, and maximum stock price. It's the best one. Which capital structure offers you this, like minimization of the weighted average cost of capital and maximize the stock price, maximize the ROE? Let's say it ROE because we were discussing this ROE. If the ROE is high and cost of capital is low, you'll choose that structure. Okay. In this situation, with calculating weighted average cost of capital, because we had like cost of debt, we have cost of common stock, common equity, and we can calculate the weighted average cost of capital. The optimal is borrowing like 750, borrowing 750, because this borrowing 750 makes cost of stock will be this, cost of debt will be this, and weighted average cost of capital will be this, the optimal. It is higher, it is lower, like very low, but you get a lot of debt. In this situation, you get a lot of debt, but your cost will be rising. In this situation, you have less amount of debt, but you have higher cost of capital. It's the lowest cost of capital, this optimal capital structure of the company. Debt to assets 37.5, debt to equities 75%. Debt to assets, equity to assets. Okay. And the price, as we said, the price we didn't discuss, okay. Okay. That's what can managers be expected to do? Okay, it's not like, let's say, need conclusion of this chapter is need to make calculations as we did, but should also recognize inputs as guessmate. Like this is expected, okay? Expected future, expected future. Like as we said, like good and bad situations, it could be happening in the future. As a result of imprecise numbers, capital structure decisions have a large judgmental context. Like it depends, okay? It depends on the situation. We end up with capital structure varying widely among firms, even similar ones in same industry. For example, let's make some example of, for example, our university. Before starting this semester, university, I think, was not sure about the future students, future intake. Yes, future students intake. It could be high or it could be low because of we had some risk of like this virus risk, about this quarantine virus risk, like future intake. So I think university like heads, they made some estimations. Yes, if it will be good situation or average as we did in the last year, or in a bad situation. For example, because this risk happens, we could be in a bad situation. We could be in a bad financial. We could have low intake. Yes, low intake. So in this bad situation, should we get some debt or not? But if in a good situation we will have high intake, I think this year we had higher, like almost half, twice as we did last year. This in a good situation for the company, in the financial terms. Should we take debt? What happens if we take debt? Okay, and these scenarios should be worked out. Okay, I think, friends, this is all for lecture. I think I also should add some lecture about like calculating, like also from the CFA book, but the main idea of the chapter about the capital structure, about the leverage, about the business risks, about the financial risks, about the fixed costs, variable costs in the business risks, about the taking debt or not taking debt, about the financial, it was about the financial risks, and at the end we had some capital structure, the optimal capital structure, the optimal amount of debt, okay, and the optimal amount of debt, as we said, and we chose optimal capital structure of the firm. Okay, that's it for today. If you have any questions, please prepare your questions on Thursday session.